Let's explore what a bond is and how it might benefit your portfolio. A bond is a loan given by a corporation or a government that borrows money from investors and pays interest on the money they loaned. Governments and corporations issue bonds when they need to raise money for projects, research, or need extra funds for expenses. So how do bonds work exactly? Let's say your city wants to fix their roads. They issue a municipal bond for $1,000 each and promise to pay you back in 10 years with an annual interest rate of 3%, which in the bond world is called coupon rate. So you buy the bond for face value at $1,000. After each year, your city will pay you $30. These payments will continue for the length of the 10-year loan for a total of $300. Once the maturity is reached, you can redeem your bond, getting your $1,000 investment back. This is considered a good deal for both the investor and the city because the city was able to complete their project and the investor was able to get a return on their investment. Since bonds get scheduled payments and a return on invested principal, bonds are viewed as a safe form of investing. Bonds do have risks though. Corporate bonds and junk bonds offer higher interest rates, which are more appealing, but these companies offering them could go bankrupt or out of business, which leaves you without your investment or interest. This is known as default risk. The higher the coupon rate, the more risk the bond investor is taking on. Credit rating indices assign credit rankings to bonds that help investors gauge the risk they are taking on. These credit indices often use different metrics for measuring risk. AAA investments are usually the best among the ratings and usually go to well-established corporations that are raising money for new products, services, or research. As the ratings drop, you get into high-yield bonds and junk bonds. High-yield bonds and junk bonds are the most risky. Safer bond investments are in the U.S. Treasury, which offer notes, bills, inflation-protected securities, also known as TIPS, and usually have maturities of 5, 10, and 30 years. Additionally, cities and states offer municipal bonds, like in our previous example. Another risk investors have to consider is resale value. This is the risk that interest rates rise, making more investors flock to the higher-paying bonds. And if you wanted to sell your bond to take advantage of the new, higher rates, you will need to sell your bond at a discount to make it worthwhile for other investors. Bonds continue to serve many key functions in your portfolio, and for older investors, bonds are and will remain the bedrock of their investment strategy. But in the current market environment, no single bond investment is really capable of producing the income and principal protection that anyone will seek. You need to get creative, and you need to customize your portfolio with high-quality corporate bonds coupled with dividend-paying value stocks, just to strike that balance between income stability and long-term growth. Now that you know a little bit more about bonds, like and subscribe. Thank you.